good people, and welcome to Dual Markets Academy. In our today's session, we are going to talk about volatile currency pairs and how you're supposed to trade them. But before we continue, if you are watching us and you have not subscribed, kindly subscribe and join the GMA family. So today, we are going to reveal what these currency pairs are and what strategies you're supposed to use in order to benefit from their price movement. So what is volatility? Volatility is characterized by rapid and frequent price movements in the forex markets. A certain currency pair could change drastically within, say, 5, 10, 20 minutes. And some of these movements could be 100, 200, or 300 pips within a very, very short time. And many people look at these movements as opportunities. I would want to move into the volatile currencies so that I can benefit from the large price movements. But the reverse is also true. The larger the price movements, the higher the risk. And that's where you need to know what these pairs are and what strategies you're supposed to employ so that you don't find yourself, as much as you're benefiting from the price movement, you are also losing greatly. And in the end, most people end up losing greatly because they don't use the right strategies for these pairs. But first, let's look at what they are. So one of the pairs is the Australian dollar and the Japanese yen. That's one of the volatile currency pairs. We also have the Canadian dollar and the Japanese yen, then New Zealand dollar and Japanese yen. And you can see here these pairs which have the Japanese yen as the core currency, they are very, very, very volatile. The fourth one we are going to look at is the sterling pound and the Australian dollar. And then we also have Australian dollar and the US dollar. So these five are the topmost volatile currencies. We also have other volatile currencies, but when you look at these five and you monitor their movements, you will find they appear at the topmost. And their movements, as I've said, they could be massive. There was a case when I saw this pair, the Australian dollar, US dollar, move up to 400 pips within a day. Up to 400 pips within a day. So whenever you hear about volatility, it is something which is very serious when it comes to price movement. So, how are you supposed to benefit from these ones? Should you shy away or should you focus on these currency pairs? And one of the most important thing to look at when you are trading the volatile currency pairs is the position size. Always go for the low position sizes. Take your position using the lowest lot sizes as you can. And we have said before, combine the measure of your lot size with your leverage. Don't utilize leverage beyond 10. Anything 5 to 10% of your leverage, it's quite okay. And that can guide you to know then what will be your lot size for this kind of currency pairs. And say, for example, if you've been working with non-volatile currency pairs, say the Euro USD, and you've been working with maybe one lot size, make sure you scale that down when you start trading the volatile currency pairs. Minimize the position sizes as you can. And the other thing which you need to look at is the stop losses. Always predefine your stop losses before you take any position. Most people work with the soft stops. There are stops whereby you say, okay, once it hits maybe 100 pips, I will exit. No. It will hit the 100 pips, you let it go, it's 200, and it might never come back down for you to recover your money. Always have a predefined stop. Although this strategy cuts across for whatever trading you're doing, but For these currency pairs, make sure that you predefine your loss before you take a position. And the other thing you need to look at as a strategy is that always choose one currency pair for your trading. Don't find yourself trading more than one currency pair which is volatile. Otherwise, you're increasing your risk and your emotions will be too high because, as I've said, you could see even movements of up to 100 pips within 5 minutes. So be careful with this kind of currency pairs. Stick to one currency pair, and once you master it, then you can look at what other currency pairs are offering. But work with one currency pair for a start. That way you will minimize your risk. And the fourth and the most important strategy you need to work with is stick to your risk management plan. If your plan is to lose up to 5% whenever you take a position, stick to that. And if you look at these top 3 points you have looked at, low position size, hard stops, or predefined stop losses, working with one currency pair, that in itself, it's a way to manage your risk. Stick to that. I can tell you there will be a lot of price movements and a lot of emotions which might make you not to stick to your plan, because when you talk about price movements for volatile currency pairs, it can really shock you if you have never experienced it before. So please stick to your plan. The plan might not work for some time, which we call the losing streak, but make sure you lose with a plan and avoid a case whereby you are also volatile, you are also rapid as the markets. Make sure that you stick to your plan and be calm. Whenever you are calm and you're not running after the markets, that's the only time you can make something out of the volatile markets. Otherwise, you rush for the volatility, you rush for the large movements, and that's the easiest way to lose or blow your account. That brings us to the end of our discussion today. Kindly leave us a comment, subscribe, and hit the notification button so that you'll be notified once we release our next video. Thank you, and bye-bye for now.